Good afternoon and welcome to the 23rd EBI Policy Series. I'm your host, Nejc Smole, and today we'll focus on climate risk strategy powered by data. Our panel discussion today will take us from climate risk data acquisition to assessment, from assessment to decision making, and in general, how to make sense of climate risk data. Before I introduce today's speakers who will shed more light on this topic, please let me quickly provide the format of our webinar. The webinar is planned for 1 hour. The panelists shall steer us through the discussion on climate risk data for the first 40 minutes of the webinar, and that should leave us with sufficient time for Q&A discussion. And in this part, the audience is also welcome to pose a question in the Q&A tool that you'll see, and I'll include those questions in the discussion later. Now, we're very grateful to have with us a fantastic panel, a very experienced panel, and composed of, yes, Shirley, Rizk, Manuel, Vicente, and Gábor, Gyura. Please let me introduce our panelists in greater detail now. Shirley is the head of climate-related and environmental risk unit in the EIB Credit and Climate Risk Department. Shirley's team is responsible for the development of models, methodologies, and policies allowing to integrate climate and environmental considerations into the European Investment Bank's risk framework. With a strong interest for development, Shirley started her career in BNP Paribas, doing structured finance in emerging markets before joining the EIB, where she first focused on restructuring of project finance operations outside the European Union, mostly in Africa and MENA region. She then moved to risk management department, where she initially dealt with equity operations before entirely focusing on climate risk and developing the first climate risk scoring models. Shirley holds an MSc in management from HEC Paris, where she specialized in economics. Now, next is Gábor Gyura, is a sustainable finance consultant at the United Nations Environment Programme Finance Initiative. Gábor is an international expert supporting banks globally to manage their sustainability impacts in line with the UN's principles for responsible banking. Besides his current consultancy role, he also teaches and does research in sustainable finance. He is a member of the Sustainability and Corporate Governance Committee of the Budapest Stock Exchange and serves on the advisory boards of several sustainability-related international organizations and research projects. Gábor spent 15 years in financial services regulation in various positions and was founding head of the Sustainable Finance Department at the Central Bank of Hungary, being responsible for the bank's green agenda between 2018 and 2022. Developing the domestic green finance market and the environmental risk management in the financial system. Gábor is currently an assistant professor at the European University Institute and holds a master's degree in economics and a PhD in earth sciences. Now, Manuel Vicente, our third panelist, is a vice president of commercial strategy at ClimateX. Manuel is an international executive with 25 years of experience in financial services with business, treasury, risk, and finance expertise. He currently leads the commercial strategy team at ClimateX, shaping and delivering solutions for clients across sustainability finance, climate, nature, and risk management. Prior to that, Manuel was a chief risk officer, Europe Wholesale and Markets at HSBC, shaping and delivering the sustainability and ESG strategy across the UK and EU regulatory landscape, and leading the global business crisis team, actively managing the impacts of Russian-Ukrainian conflict on clients and operations. Prior senior positions of Manuel's include also group risk, regulatory, and data lead for IBOR transition, group risk lead for Brexit, and US head of capital. Manuel holds an MSc in business engineering from Louvain School of Management and a sustainability and climate risk certificate from GARP. Now, a warm welcome to our panelists once again. And without further ado, we'll dive into the topic of the necessity for data. In the background, you see that we have structured our discussion on 4 pillars, and we will go through these pillars in this particular order. So we'll start with the question of why do we need data? The Paris Climate Agreement, adopted at COP21 in 2015, established a new global framework for addressing climate change through enhanced transparency and accountability mechanisms. To effectively implement and track progress under the Paris Climate Agreement, there's a critical need for comprehensive, reliable, and timely data. I'd like to start by asking Gábor how the Paris Climate Agreement has stimulated this push for new data and the role of data in the commitments that have been made on the path toward net zero carbon emissions. Gábor, the floor is yours.
Thanks, and good afternoon, everybody. You used a very nice expression by saying that basically the Paris Climate Agreement basically inspired new data needs, or what was basically your term. So sometimes, of course, banks talk about more like a regulatory tsunami coming with the Paris Climate Agreement and with all the data needs it brought about. I think it's helpful to maybe structure these, let's say, banking, regulatory, bank policy developments into basically 2 major territories. So that's at least that's the way I see things. So first of all, there are the climate risk related policies, and there are the others which I tend to call the alignment related policies. So obviously, not just in Europe, but also beyond Europe, climate risk has really very quickly risen high on the agenda of regulators and central banks and supervisors. So I think the Paris Climate Agreement very clearly showed that we need now to count with physical climate risks, even if we can mitigate some of them, maybe the worst of them, hopefully, but they will come, and they are already having impacts on the financial assets of banks and other institutional investors. And of course, the other big area within climate risk are transition risks. And again, in Europe, starting first with recommendations, guidance is issued by central banks, the ECB, but also some national central banks. And now this has been incorporated into the capital requirement regulations and directives. This has really become an explicit, let's say, task prescribed by regulations for banks, but also for their supervisors, basically to incorporate climate risks into the supervisory review process. But I think very similar trends are happening also outside Europe, also thanks to the coordination work of the NGFS, so the network of for greening the financial system, which is the platform of the central banks and supervisors. But beyond climate risks, which again come with already with huge data needs, we should not forget basically the other angle, which is alignment, because of course the Paris Climate Agreement really foresees that we need to make sure that financial flows also align with the objectives of the Paris Climate Agreement. And here again, we can just maybe recall the EU taxonomy regulation, basically making it clear when can an economic activity be classified as environmentally sustainable, but also, for instance, for the asset management industry, the Sustainable Finance Disclosure Regulation has a very strong impact perspective, not just looking at risks, but also how investments can contribute to the green transition. But we can also mention regulations and policies with the scope of public companies, the Corporate Sustainability Reporting Directive. Basically, all these are pieces of a big puzzle. How can we make sure that actually all economies in Europe, but also hopefully outside Europe, go towards the Paris Climate Agreement? And of course, just to close, obviously, all these come with huge data needs, which basically these needs were largely non-existent before all these regulatory developments. And everything is so urgent. Everything is, of course, expensive. So I think we really need to be very smart how we can address these data needs coming with the Paris Climate Agreement and these policy developments.
Yeah, thank you, Gábor. That was very clear. And since we have a bank representative amongst us, would be interested to hear how has this policy push, this policy development, also for new data, how has this impacted banks, and in particular in terms of identification of risks and opportunities? Shirley, would you like to respond?
Sure. Good afternoon, everyone. So indeed, I think bank's journey is reflecting this regulatory evolution that we've seen. It all started in the wake of the Paris Agreement with the start of the TCFD disclosures, which were voluntary disclosures and relatively soft disclosures, I would say. And banks started by having top-down analysis of the risky pockets in their portfolios, mostly based on sectors, geographies, etc. Then we had the central banks, indeed, and in particular the ECB in Europe, really going deeper into the topic and requiring banks to include these risks into every aspect of decision making concerning credit, but also any kind of other risks, but also strategy. So I think there banks really started to go deeper and analyze those risks at a more granular level, looking at their counterparties and progressively engaging with their counterparties, because of course data was not always available for the whole portfolio, only for the big listed companies. So it's been a journey, and I think now the interesting next step is the CSRD, which, I mean, Gábor, you mentioned the tsunami, regulatory tsunami. I think this one is a real tsunami in terms of data points required for disclosures. It's also expected to create a huge amount of information and transparency to avoid greenwashing, but also inform better decision making, be it lending or investment. And what I would like to mention is that I think although this comes from a regulatory push at the beginning, I think there is progressively a real acknowledgement by banks that those risks can be material, especially when you lend long terms. And even though most banks started with transition risk, which is somehow easier to grasp, I think now the real acknowledgement is that physical risks are here and they're here to stay, and they need to be properly assessed and quantified. And that's a big challenge.
Okay, thank you, Shirley. So now, if we take this tsunami into account, to stick to the theme, how do you get the board to care about, you know, all this data? How does that potentially impact your strategy? Manuel, would you offer some insight in that?
Thank you very much, Nejc, and thank you very much to both panelists for their insights. Good morning, good afternoon to all. I think the first thing we need to remind ourselves is the responsibility of the board. So what is the board set up for? Effectively to set strategic direction of the company, to align to the stakeholders' sort of expectations, but also, and importantly, to oversee what the management team and the executive team are doing in terms of delivering against that strategic direction. So I think climate data is very crucial in that phase, because with climate data, they can make informed decision, whether it's to integrate into their business strategy, whether it's to drive any investments or resource allocation to that topic, or finally, whether it's to align to the external stakeholders. And I'll just pause and sort of provide a couple of examples that I've had myself with boards, having faced many boards across my career, and more recently with the sustainability agenda. I think the first thing is that there seems to be a reticence to put data in front of the board if it's not complete and if it's not accurate. And I think we're in a journey where we have to be courageous and we have to be innovative. And this is more about direction of travel rather than full accuracy to 100%. So in my previous experiences, I have pushed the teams and myself to put data that was providing sort of direction of travel, but maybe may not have been sort of 100% watertight. So I think that's the first one, is that we really need to be courageous on this journey and take it. And of course, distill all the assumptions of the data to our board, so at least they know what they're looking at. But I think that's one first example. The second example that I've had with engaging with boards is that there is sometimes a tendency to scare the senior management, shall I say, maybe with tsunamis, as we were using the word just a minute ago, but also with, oh, it's all doom and gloom. It's all risky. It's all problematic. These clients or these sectors are not having a transition plan. They haven't thought about physical risk, etc. Actually, what the board wants to hear is the next step, which is the so what question. What are we going to do with this data, and how are we going to drive a much better and fulfilling client engagement, and also engagement with the local authorities, that we build, you know, a better and safer environment and more resilient environment. So I think it's very important, I guess, to one, put information in front of the board, and two, be courageous to talk about solutions as opposed to just problems, and try to push adaptation finance and other key initiatives which we need to drive with our clients. And I think on that note, I think I'll probably hand it over to Gábor, who has a few things to talk about adaptation finance and sustainable finance.
Indeed, yes. Thanks a lot, Manuel. This was very clear, and yeah, thank you for the transition. I think we'd be very interested to hear from Gábor on, you know, transition with the adaptation finance. Can adaptation finance be used by banks to manage physical climate risks? And if you have any interesting examples to share from your experience from UNEP FI role, and what is the role of data to support this in particular? Thank you.
Yeah, I'm actually very glad that this is also part of our topic, because when it comes to climate and climate strategy, we tend to talk, for good reasons, a lot about climate change mitigation, how urgently we need to reduce emissions in the real economy, which is of course all true, but we tend to forget that there is also the adaptation angle. And we started the discussion with the Paris Climate Agreement. Well, actually, the adaptation is also a very important pillar of the Paris Climate Agreement. And actually, banks can really do probably more about adaptation, just as they, I think, stepped up in many countries their climate change mitigation action. So, of course, maybe it's useful to start with risks, because, as we mentioned, physical climate risks are already basically on the agenda of banks and also their regulators. So banks already need to address physical climate risks, but there are many different ways to address physical climate risks. And of course, there are some which are more helpful for the adaptation, let's say, of the country or regions or communities or clients, and there are some others which are maybe perfectly suitable, at least on the short term from a risk management perspective. We can maybe mention risk avoidance, exiting certain client relationships, stopping to finance certain clients or certain collateral types in very specific territories, maybe subject to flood risk. So I would call these kind of potential, let's say, physical risk management approaches something which could really be improved. And this is where adaptation and basically the more holistic view with adaptation can come into play. Basically, probably on the long term or midterm, much better way to address physical climate risk is when we are really helping the clients as banks to mitigate their own physical climate risks. And we're not talking about avoidance, but making basically clients or communities more resilient, making sure that they are aware of what is coming. So there is also obviously an advisory role for banks. And I think increasingly we are seeing that many banks also assume this kind of advisory role, advising their clients about what is coming and how they can actually maybe change some of their business activities, or even other ways how they can adapt to these upcoming risks. Well, the problem, of course, with adaptation finance is there are much less clarity on metrics. When it comes to greenhouse gas emissions, which is probably the most important metric, of course, for climate change mitigation, this is, of course, this metric has its depth and that has its data challenges. We can talk about, and I'm sure we will be talking about this. But for adaptation, there is no single metric. There is very difficult to come up with good KPIs for adaptation. How can a bank know if it's already doing a good job in terms of adaptation finance? So there are obviously a lot to do, a lot of challenges, but maybe let's say also say at least one or two promising things, again, from a policy perspective. So first of all, let's not forget that also the EU taxonomy has an adaptation part. And actually, adaptation as part of the do no significant harm criteria should also be always be considered when it comes to any kind of a green financial transaction for a bank or an investment fund. And for the UN, we just recently published our guidance for banks, how banks can strategically work on adaptation, how can actually banks set targets on adaptation. And this is still a very new guidance. I really hope that more and more banks will use this and step up how they can contribute to the much needed adaptation challenge globally.
Thank you very much. Thanks, Gábor, for this very exhaustive response and very clear response as well. And when it comes to climate change adaptation more broadly, if we stick to this topic, what are the typical strategies that banks can pursue? What kind of opportunities and potential capital deployments toward adaptation finance can be supported by data? And maybe I could ask Shirley to respond to this.
Sure. So, as you may know, the European Investment Bank is the EU Climate Bank, and we are the world's largest provider of climate finance. This being said, we find that stepping up adaptation finance is much more difficult than, extending large amounts of mitigation finance. And we are indeed looking at how to explore new opportunities. I think the first step, the low-hanging fruit, is first to mainstream adaptation as part of our current operations. We are long-term lenders and we are lending to infrastructures. So we need to make sure that the assets that we finance can withstand future risks, even when they increase in severity and frequency. So that's the first thing. And we have adaptation specialists, looking at every new operations and looking at the future risk and making sure that the assets are designed to be resilient to those risks. And if needed, we engage into a dialogue with the clients to make sure that all the necessary measures are taken. Now, going beyond these built-in adaptation measures is much more difficult, also because very often clients themselves are not very much aware of the risk or not sensitive about the risk. So that's where data comes in, actually, because by gathering data at counterparty level, we can have a first rough assessment of how exposed the counterparty can be and engage into a dialogue with them on something broader than just the project we are financing. And this is something that for the moment we've seen with sovereigns. They come to us and say, we have issues and please finance us, please help us, etc. But with private companies, it's much more difficult. So we are really hoping that increased data availability can help us identify new opportunities.
Okay, thank you very much. Manuel, would you like to add?
Sure. If I may also, yes. I was just reflecting on what Gábor and Shirley were sharing in terms of their experience. And I think also we need to push the boundaries. So when we identify these risks out there, I just remembered an anecdote with one of the boards I was dealing with where the first reaction was saying, well, you're going to stop lending. You're going to stop lending to this counterparty because they're not doing enough on transition, or you're going to stop lending to this area because of physical risk. And actually I flipped it the other way around, which is actually it's on the contrary. This is the best opportunity we have on the table. These are the individuals and the companies that need the most help on the table. Let's go and help with our expertise and data and insight on the market to try and turn around the situation and help them come along the way on the transition path or on the physical risk mitigation and adaptation. So I think it's also a mindset of solutionizing when there is a problem. And I think it's obviously you need to look at risk appetite and you need to look at how much you're willing to work on that path with your client, and at which point sort of you take a decision on a client. But I think it's important that the first approach should be a positive one of solution driving through adaptation and through transition planning. So I think I just wanted to reiterate that solutionizing. It's not because something is looking not good that we should walk away. Actually, it gives us a good opportunity to make it even better. Sorry, I just thought I'd share that.
Yeah, that's clear. Yeah, thank you, Manuel. And maybe if we go also back to Shirley on another question that I have. So how far are the banks in assessing their data needs to inform their strategy setting and risk management, to identify the gaps compared with current data and to devise a plan to overcome these gaps? How far would you consider the banks have come? And if I may, additional sub-question, what have been the developments like in the last year in terms of addressing these data gaps? And which areas would you say are still left to be understood a bit better? Thank you, Shirley.
Well, I think it's been a big journey, and as mentioned before, banks have evolved from a top-down approach to a more granular approach. So once they have assessed the maturity of a certain of the risk in a certain region or in a certain sector, they go deeper in analyzing the risk at counterparty level. And this has been allowed by increased disclosures by companies, by the development of also proxies by external providers, and by the development of engagement policies as well, because you cannot have all of your clients covered by external providers. So I think banks have started that dialogue with the clients on both transition risk and physical risk, and that's very important because, as Manuel said, I mean, the intention is not just to drop, you know, the clients which are at risk. It's to help them transition, maybe from the decarbonization perspective or from the resilience perspective. And that's very important. And that's what we want to do as the Climate Bank, is to accompany our clients in that journey. So I think right now we are in a position where we have a mix of external data, internally collected data. We have to make sure it's consistent. And then to close the remaining gaps, we have proxies which are of different levels of quality. And what's very important, I would say, is to be able to use that data for some meaningful decision-making process. So when it comes to credit, which is my field, it's, you know, how will it impact our assessment of the probability of default of the LGD? How do you do with that in terms of pricing, contractual clauses, etc. But then also, how does it inform your strategy in the end? You know, what do you want to make to do with this with these clients? Do you want to set limits? Do you want to set targets and, you know, to revisit the relationship after a while? So yes, I would say risk and strategy are very much intertwined, and we are in a position where we have you know, different sources of data that we have to reconcile and ensure the consistency of.
Thank you, Shirley. And then, of course, you know, since data is the first part that we need to put into the puzzle that contributes to the greater strategy, how do you actually ensure and check the data reliability? What kind of approaches can you take? Manuel, would you offer an advice?
Yes, certainly. Thank you for that. We have had it in the history of, shall I say, of banking over the past 10 to 20 years, our own sort of challenges on data on all areas in terms, and that's why we saw the creation of central data lakes, chief data officers, chief information officers. So we do have a good track record of what good looks like effectively on data. I think it's important, to Shirley's point, whether you gather internal data or external data, you should be applying the same sort of approach to it to make sure that when you actually use this data to drive your client engagement, you can rely on it. So I think the data, whether it's external or internal, has to be quite granular in nature. In other words, if you're looking at physical risk, you have to be looking at a very specific asset. You can't just do a broad brush analysis. You have to be very transparent on the models that you're using, because as we said, you don't have data for everything. So you're going to have to come up with models sometimes. And again, you have to be very clear on the models that you're actually using and document their limitations. And then finally, the other point I would say on the data is you really need to make sure it's easily retrievable and you can actually digest it and present it to your seniors. So for example, I just have an example again, just to share with you. In terms of mortgages, granting a mortgage, looking at physical risk of the underlying asset, residential, you know, maybe some of us on the call have a mortgage. You want to make sure that when a bank is assessing the physical risk on your house or your flat, that they're doing it in a very fair way. So you cannot accept that the bank or anybody else will be using a high-level flood map that will tell them that there's a high flood zone and automatically look at all the mortgages in that zone and decide we're not going to lend in this area because it's a high flood map. You need to be able to pinpoint to the specific asset and the specific hazard impacting that asset, and then you can take a decision on that. So I think that's where granularity and transparency is very important in how you use the data. And then you can also use that data to go and engage with your local authorities to say, hey, we wish to build or help you build resilience in those specific pockets of areas in that region. So I think there are sort of nuances in the data that you use, but it's important that you have reliable and granular data to the best that you can. Yeah.
Yeah, thanks, Manuel. That was a really good example indeed. And if I just may come back to Shirley. So we have established the fact that we have some data. We have established the fact that the data needs to be reliable. Still on the path towards strategy setting. How would you integrate this new data into the decision-making process? Which data points do you trust? Shirley, would you have any suggestion?
Yes, sure. One example I can give is the framework we have developed as part of our commitment to have all of our operations Paris aligned. So basically, we've established screening criteria for counterparties for new clients for both transition risk and physical risk. And based on these criteria, if certain thresholds are exceeded, for instance, if more than a certain percentage of revenues are coming from the high emitting sectors, we would engage with the counterparties to check whether they have a decarbonization plan in place, whether this plan is complying with our criteria or not. And if not, then ask them to develop one. And we do the same for resilience. For resilience, I have to say it's much more difficult because, as Gábor was saying, there's no real metric, so it's much more of a qualitative assessment. It's difficult. Sometimes you cannot have all of the assets location, etc. So it's a bit more challenging, but we're trying to engage with the clients and to at least open that debate and make sure they're aware of the risk and themselves then able to look at their operations in a different way. So that's one. And second is, of course, then inclusion in the risk management process, as I was mentioning earlier, and how, from a quantitative perspective, we'll be able to take into account those data points. And here again, it's much easier from transition risk perspective. You can put a carbon price in your sensitivities and assess what will be the future probability of your profitability of your clients under different scenarios. For physical risk, it's much more difficult. You need to develop damage functions, and then the assumptions are very complex to decide upon. You can purchase also damage functions from external providers, which have given a lot of thought about the topic, but then you need to make sure that the algorithms are transparent enough for you to use in your actual decision-making process, not just as a sensitivity, but really to impact your PD and then in the end your pricing. So I would say for the moment, much easier for transition risk than for physical risk.
Okay, thank you, Shirley. Very clear, very clear. And if I move now on a little bit on to the greenwashing concept, since this is also a very important part of data and data reliability. Maybe I can turn to Gábor with a question on how can data facilitate an objective assessment in a context of this growing concern of greenwashing that we also see being more and more prevalent. Would you have any suggestion?
Yeah, absolutely. I think this is a very, very important topic as well. So it's not just climate and environmental risks that now matter for banks and their supervisors, but also greenwashing risks, which I think it's in itself also has like a positive message. Basically, it means that green finance has risen. It has become important. Banks are believing in green finance. It seems valuable for their customers, for their investors. So that's why greenwashing is an issue. But it's a real issue, and of course, for the integrity of the green financial market, it's very important to tackle greenwashing. Again, let me maybe just start from policy, and then let's get to data. So I think from a policy perspective, it's important that now, let's say, definitions for greenwashing in a financial system are emerging. They are not quite there yet, but basically this is now in the pipeline. Of course, it's also very helpful that we cannot just define greenwashing itself, but first we need to define what green is, and that's again why the EU taxonomy is so important. So we already know basically when an economic activity is green. We just need to a little bit finalize that policy landscape by also defining greenwashing explicitly, so that basically this kind of legal uncertainties that are already in the system can be mitigated. I think it's also useful to a little bit define, okay, what are the typical well, I should say use cases for greenwashing. What are the typical greenwashing issues? So first of all, there are of course greenwashing issues with financial products, mostly investment products. There again, I think even if we haven't found the perfect solution, but the Sustainable Finance Disclosure Regulation, so the SFDR, does a lot of helps a lot to mitigate greenwashing risk. Why? Again, because it comes with standardized templates with a lot of data points, well-defined data points. Of course, again, this creates a lot of headache to asset managers and institutional investors because it's very difficult again to get all those data for the financial products. But actually, the definitions are there. We know what kind of data points are needed so that we can mitigate the greenwashing risks with investment products. And then, of course, there is the net zero perspective that's more relevant, I think, for banks. So there have been some net zero related greenwashing issues. So some banks have been put under criticism because of maybe ununderpinned net zero claims. And there again, I think data can help a lot. When banks publish their net zero targets, they need to, of course, publish their baseline emission metrics. They need to disclose their assumptions. Data quality as well. There, the PCAF standard is extremely helpful because it created, let's say, a standardized way how we can classify data quality for finance emissions data. And also going forward, basically, year by year, banks need to publish their progress towards the net zero targets. So again, this brings us to data, and especially finance emissions data. So I think they're basically making sure that all these finance emission metrics are credible, can do really a lot to mitigate the greenwashing risk coming with net zero claims.
Okay, thanks, Gábor. So I could say that by now we've traveled a distance within our discussion from policy origins into what can institutions do with some data that is available for certain aspects of risks, and then how do you verify the reliability of that data, and then how do you integrate this into the strategy? But what if we ask ourselves, what would you do if you have no data, still no available reliable data for a particular issue that you would like to tackle in terms of your understanding of riskiness? How in this particular situation, what is the role of expert judgment and assumptions to be used? Perhaps maybe we could ask Manuel to help us out.
Yes, and apologies. I realize obviously we want to give the panel to the team to ask us some questions, so I'll try and whiz through this. I guess the first reflection I had as I was preparing for today was that this is probably not the first or the last time that we're facing an event where we don't really have data or limited data. I'm sure we can all personally think about events, let's say 2-3 years ago, 5 years, 10 years, 15 years ago, where we had events happening out there. There was no model, no data, and yet for some reason we were able to work through them and distill the key elements and drive action. So I think just a bit of a reflection that saying there is no data is probably not an acceptable answer, and we just need to really think about solutions. So I guess I'm an optimist, and if you define clearly what you mean by data, you always find a way to sort of get there. Just had 3 examples that I wanted to sort of quickly share, and hope, for example, innovation can take us through those challenges. The first one is really, I think Shirley was referring to it, in the banking sector. We send out ESG questionnaires to our clients to capture information about how they're doing on transition risk, how they're doing on physical risk. And that's quite a long and lengthy sort of process. It yields, mixed results, I would say. Sometimes it's incomplete, especially when you go beyond listed companies. A much better outcome would obviously be, for example, if we look at physical risk, if we could have the information on the physical assets of a client, that would be a lot more powerful when you go and engage with a client, and it will do away with all the noise and the administrative element of collecting the data. So applying innovation in this space, which some of us have been doing, provides to exactly that point. It provides data to the banks, data to clients, And now you can actually engage on a solution on what are we going to do about these assets which are risky. So you focus the attention on an opportunity to move forward as opposed to collecting data. So I think that innovation in that space sort of helps a lot. Another element, for example, is gathering building asset vulnerability and physical risk. As we all know, in emerging markets and very specific emerging markets, remote rural areas, there isn't a lot of data around their building. So you have to innovate. You have to look at satellite site imagery, which can allow you to effectively look at the type of build it is. You can do some research on the type of construction in the area. So you push the boundaries. The data is initially not there, but it is somewhere else. And then you start collecting on these alternative sources. And then finally, one other point about energy efficiency. We obviously have all our different energy efficiency systems across Europe and the UK and the US. If I just look at the UK, for example, energy efficiency data on buildings is not readily available for a good chunk of the population. And so in this case, you have to go into proxying and modeling. So you do need to come up with a model, and then you have to be very transparent on how you came up with a model. So I think, I guess 3 examples of where, the first approach is there's no data, walk away and just moan about it, or actually you innovate and you push the boundaries and you find a solution along the way. And I'll pause there, and I think maybe Shirley also has some experience on her side on no data and how you navigate.
Yes, definitely. Happy to hear from Shirley.
Thank you. Sorry. No, I think Manuel already gave a very good insight of what the innovative solutions could be. I think for the moment, yes, we're trying to bridge the gaps with further engagement. And what we find is that even when having the best data available and going through these innovative solutions, in the end, for the difficult cases, you still need expert judgment. And you need expert judgment to engage with your clients on the credibility of their decarbonization plans, because it's not enough to have a net zero target, even with intermediate targets, because sometimes you find that there can be net zero targets with an exit to coal only in 2045. And you need to reflect upon the resources that are actually dedicated by the clients to this plan. Is there a real capex in front of this plan? Is there a real managerial commitment? So I would say it's still, data by all means is very important to avoid greenwashing risk, because it gives you very important insight about the starting points and the direction of travel, but engagement is key. And on resilience, I think here, of course, this is where innovation is really welcome. But there is no one-size-fits-all solution for adaptation. So I think here also we need to reflect with the clients about the best solutions for each case.
Thank you, Shirley. And Gábor, would you also like to complement?
Yeah, but just maybe very, very briefly. I think I would just maybe highlight really the importance of cooperation within the banking industry and cooperation with regulators. I think in every country we see this first mover disadvantage, like nobody wants first to move to the client and ask for new types of data, which is maybe a burden for the client, especially if the client doesn't get anything in exchange, like a discount on the interest rate or whatsoever. And I think this is this is game theory. There needs to be a solution to this kind of situation. I think like in many cases, the solution is basically that, for instance, banking associations coordinate the kind of data that is requested from SME clients, so that we avoid that basically different types of data and different data points, different metrics are used when basically SME clients are bombarded with new data requests, or the other solution is when basically, and I also see this in some countries, that basically banks together advocate at the regulator, and basically and the regulator centrally, let's say, prescribes some new reporting requirement for companies, and then again it overall reduces basically the coordination costs and compliance costs for everybody in the system.
Thank you, Gábor. Yeah, indeed. I think this was a pretty comprehensive collective response. And before I go and open the floor for everyone, for all the participants here, As I mentioned at the beginning, please feel free to send us a question in the chat. I'm happy to send this forward to one of our panelists. But before we do that, I also have another burning question on proxies. So proxies for physical risks. I would like to ask Manuel perhaps to elaborate on this question on what types of proxies and assumptions are used for physical risks management purposes, and which physical risk data are most in demand given what you see right now, and which data are still not very much available, and what's being done about that. It would be really, really helpful to hear your views on that. And in the meantime, please feel free to ask any questions in the chat. Thank you.
Thank you, Nejc. Yes, so I guess I will share my experience, but also I will share what the regulatory what the regulators have been sharing with us in terms of thoughts. We had the ECB who have shared these type of issues. We have the UK under the CBES, and we also had the recent Fed report in the US that was published in May 2024. And they all seem to have a trend around some specific areas, for instance, around physical risk. They all refer to things such as building data, so making sure you have information around your building and your specificity of your asset. That seems to be a recurrent theme in terms of having information out there. They all refer to potentially having an extensive coverage of all your hazards. So a lot of companies out there have started, let's say, with flooding. Then they moved on to drought, but they still have yet to make a progress in terms of having a complete library of all of your underlying hazards. And then they also talk about having a view of your counterparty. So when you think about physical risk, it's very asset driven, but the most important thing is you're able to connect that asset to the activity of your client. And to Shirley's point, if you're looking at credit risk, for example, you need to be able to connect those two. Otherwise, you will not be able to assess any potential credit risk to your client. So that connectivity between a client and an asset is a crucial thing, and it seems to be a recurrent issue. So I think that's where you have to start innovating in these areas. And as I said before, in terms of a couple of examples, have a library of all your building vulnerability globally, have the capability to connect a client with all of their assets and provide that to the industry. You basically need to constantly and then also have a wide library of physical hazards that you cover. So you really need to start working on those elements and build up from there. So I think, very interesting challenges that we're working with clients and others, but yeah. And maybe if I may also on that topic of proxying, I think it's a close partnership. My vision of this is that you need specialized teams that know the science and know data on buildings to collaborate very closely with specialists like Shirley, for example, who know about their credit models and the PD and their counterparties. And I think those coming together are very powerful in terms of collaboration. So basically people who are doing this in the corner of the desk and who have other jobs to deal with, but actually people who come in at 8 in the morning and leave at 6 in the evening or whatever is the time, and are obsessed about the data and obsessed about that. I think that's quite helpful also. Sorry.
Certainly, yeah. No, thanks a lot. May I just ask you, Shirley, as well, if you would like to complement anything from your perspective, from working within the bank, and what are some of the ways that you're addressing these gaps that are, let's say, asset specific?
So I don't wish you a struggle, to say the truth, but indeed, I mean, at best, what we get is the location of the assets. In some very specific cases, when we are above these certain thresholds and we engage with clients, then we can get to know what are the types of assets that are where. But in general, we just have asset locations, and we don't know whether these assets are, key operational sites like plants or logistics hubs or data centers or just offices, and if they're flooded, people can telework, so that's not the problem. And even if we get to know the type, then it's very difficult to know what is the contribution, the P&L contribution of that particular site to the company. So basically, what are the critical assets? unless you engage with the client. For the moment, it's very difficult, or indeed, I mean, then you test some very innovative solution. That's potentially one of the way forwards to avoid putting a huge burden on the clients, as Gábor was saying. So yes, looking forward to explore these new innovative solutions, but for the moment, still a challenge.
Okay, thank you. And you haven't concluded on innovative solutions. The question that is triggered as well is what are the future data improvements, and what are the opportunities on the horizon that we have? Perhaps maybe Gábor, you would like to tackle this question.
Yeah, great question. Let's all try to bring our crystal balls to the discussion. Well, my crystal ball tells me that hopefully in Europe, I think tsunami. Maybe the tsunami is not over, but basically the most parts are already behind us. So what I maybe expect is more like implementation. So making sure that we are doing properly what needs to be done, like improving data quality for reports that are already existing. And of course, like we know that this was also mentioned today, that many companies are now starting public standardized, legally mandated sustainable reporting, which is really great news, I think, for banks, but also for capital markets. So I'd rather see maybe the challenge on the horizon with SMEs. We need like smart solutions for SMEs in Europe, but also outside Europe. Scope 3 emissions, I think when it comes to measuring the emissions of portfolios, there are still some blind spots, especially with Scope 3 emissions. And if I had to find maybe that like the most interesting area is a little bit how we go beyond climate. And here, of course, like biodiversity, nature, and especially the nexus between climate and nature is so important. And we could really dedicate a whole workshop to biodiversity and nature. And of course, its data needs are much more complex basically than climate's. And this is not to say that climate is easy. So probably the most interesting and biggest challenge is how we can really also address nature loss and what banks can do to stop nature loss, and how can actually data used to really work strategically around nature for banks, again, in Europe, but also beyond Europe.
Thank you, Gábor. And what about Shirley? What do you think, given that you've concluded with the necessity for data improvement? What are your thoughts around the future data improvements, and what are the opportunities on the horizon in your view?
Sure. Very, very quickly, maybe. So I already mentioned the asset level data, which is still a challenge for us. Maybe more from a transition risk perspective, I think it's great that the taxonomy regulation will provide for the very green share of activities of our clients. Now, what we also need from a risk perspective is the brown share. And so I know that normally we should have at some point a taxonomy of transitional activities, but again, knowing what are the brown shares of our clients is crucial to us. And then I would say more from a forward-looking perspective, having some more granular scenarios would also help a lot in our analysis when we lend to new clients, because for the moment you have high-level sectors and it's difficult to translate the variables to the counterparties which are in more specific segments of these high-level sectors. So looking forward to this, and also for these scenarios, of course, to embed some nature-related risks, as Gábor was mentioning.
Okay, and I would also like to give the opportunity to Manuel to share his thoughts on what the future may bring and what kind of opportunities are on the horizon. Thank you.
Thank you, Nejc. Yeah, I think if we think about the wider ESG, we're on a journey going from qualitative to quantitative in a nutshell. So if we look at the last 4 or 5 years, we've been trying to work on transition risk. We've had successes, and then other areas that are still being worked upon. I think the physical risk journey has started catching up with us, and sort of we're certainly there or thereabouts in terms of identifying the key areas where we need solutions and providing solutions to those. But then really the exciting point, which is, you know, to use Gábor's sort of tsunami, use a verb he used at the beginning, is probably nature and the wider environmental, and it's how you take it to the next level and start looking at impacts on the impacts of the activity on nature and the dependencies on nature, and then taking it to the next level. So I think it's a fascinating sort of journey. And as Gábor said, and Shirley, I'm pretty sure we could do another session just on nature, because that's the next challenge down there. So so yeah, very, very interesting to be on this path. Yeah. And a privilege also to be here with all of you, sort of sharing our thoughts.
Yeah, thank you. Thank you, Manuel. And I think looking at the time, this brings us to the end of today's session. Since we haven't received any questions from the participants, it just makes me think that the panel today was incredibly good at explaining all the intricacies around the data needs in climate risk and climate risk management. I would like to thank everyone for your attention. We hope you've enjoyed this installment of the EBI Policy Series. And once again, I would wholeheartedly like to thank our guest speakers for their really intriguing discussion. Very, very, very clear perspectives. And I would also like to thank my colleagues at the EBI who've worked hard to organize this event. It's very nice to see that as well. And thank you very much for your attention, and hope to see you soon again. Thank you.